Imagine walking into a small roadside shop almost anywhere in Africa. Whether you're in Lagos, Nairobi, Accra, Johannesburg, or a remote village hundreds of kilometers from the nearest city, there's one product you're almost guaranteed to find. A bottle of Coca-Cola. Not just in supermarkets. Not just in restaurants. But in tiny neighborhood kiosks, roadside stalls, open-air markets, and family-owned stores where electricity isn't always reliable. Now here's the surprising part. For decades, Coca-Cola and Pepsi have been fighting one of the biggest corporate rivalries in history. In countries like the United States, they've traded market share, launched massive advertising campaigns, and spent billions trying to outperform each other. But in much of Africa, the rivalry produced a very different outcome. Coca-Cola didn't just edge ahead. It built an advantage so deep that in many places, Pepsi has struggled to match its reach. So how did one of the world's greatest business rivalries become so one-sided across much of the African continent? Was it better advertising? Lower prices? Superior products? Or did Coca-Cola discover something far more valuable than its biggest competitor? The answer reveals a business strategy that goes far beyond soft drinks, and it offers lessons for anyone trying to build a lasting business. This is the story of how Coca-Cola defeated Pepsi in Africa. To understand this rivalry, we first need to understand Africa itself. Africa isn't a single province. It's a continent of more than 50 countries, thousands of languages, diverse cultures, and rapidly growing cities. What works in one country may not work in another. For any local company, succeeding in Africa isn't a matter of landing or simply shipping products overseas. It demands patience, local knowledge, and long-term investment. For beverage companies, the opportunity is enormous. The continent is one of the world's youngest populations. Urban areas have expanded quickly over the past several decades. Disposable incomes have gradually increased in many communities, and millions of new consumers have entered the marketplace. To global brands that represented tremendous long-term potential. But there was one major obstacle: reaching those customers. When many people think about Coca-Cola, they think about commercials. The iconic red label, holiday campaigns, celebrity endorsements. But inside the company, executives understood something that competitors often underestimated. A great advertisement means very little if customers can't actually buy the product. Imagine seeing a commercial that makes you crave a cold drink. You walk to the nearest shop. The shelf is empty, or the drink isn't available at all. In that moment, the marketing has failed. Coca-Cola understood this decades ago. Instead of focusing only on convincing people to want the product, the company invested heavily in making sure the product was already waiting wherever customers went. That philosophy became one of its greatest competitive advantages. And in Africa, it proved even more important than television commercials or billboards. Most consumers never think about what happens before a bottle reaches a store. They see the finished product. They don't see the factories, the delivery trucks, the warehouses, the bottling partners, the thousands of small business owners who stock their shelves every day. Yet these hidden systems determine whether a company succeeds or fails. Coca-Cola recognized this early. Instead of trying to manage every operation directly, it expanded through local bottling partners who understood their own markets. These partners invested in production facilities, distribution routes, and relationships with retailers across different regions. That approach created something incredibly difficult for competitors to copy. It wasn't just a brand. It was an ecosystem. And every year that ecosystem became stronger. Because every new warehouse made future deliveries easier. Every new retailer expanded the company's presence. Every additional bottling facility shortened delivery times. But having a strong distribution system still doesn't explain everything. After all, Pepsi is one of the world's largest beverage companies with enormous financial resources. So if Pepsi had the money, the global reputation, and the experience, why couldn't it build the same kind of dominance? The answer lies in a series of strategic decisions that changed the competitive landscape, and that's where the rivalry becomes even more fascinating. At first glance, this rivalry shouldn't have been so one-sided. Pepsi wasn't a small challenger. It was already one of the world's largest beverage companies, with billions of dollars in revenue, global brand recognition, and decades of experience competing with Coca-Cola. In many countries, Pepsi had proven it could stand toe-to-toe with its biggest rival. Through bold marketing campaigns and strategic partnerships, it had built a loyal customer base around the world. So why didn't the same formula produce similar results across much of Africa? The answer begins with timing. By the time Pepsi intensified its efforts in many African markets, Coca-Cola had already spent years building relationships that couldn't simply be bought. Retailers knew the local distributors. Delivery routes had been refined. Bottling plants were already serving surrounding communities. Pepsi wasn't entering an empty market. It was entering one where the foundation had already been laid by its biggest competitor. And in business, arriving second doesn't just mean competing with another product, it often means competing with years of accumulated trust and infrastructure. Most people assume Coca-Cola's greatest asset is its famous drink. In reality, the company's greatest asset may be something far less visible. Its ability to deliver the drink almost anywhere. Imagine owning the world's best beverage. If customers can't find it when they want it, someone else's product will fill that gap. Coca-Cola understood this long before many competitors did. Across many African markets, the company invested in an extensive distribution system designed to reach both large cities and smaller communities. Instead of relying only on major supermarket chains, it built relationships with thousands of independent retailers, the small neighborhood shops where millions of people make everyday purchases. Those stores became the front line of the Cola War. Each one represented another opportunity for Coca-Cola to be available at the exact moment a customer wanted a cold drink. Over time, availability became habit. And habit became loyalty. One of Coca-Cola's biggest advantages was its willingness to think years ahead. Instead of chasing only short-term profits, the company continued investing in markets that still had room to grow. That meant expanding production capacity, strengthening distribution, and supporting local operations even when immediate returns weren't guaranteed. These investments required patience. But they also created barriers that became increasingly difficult for competitors to overcome. Every new bottling facility reduced transportation costs. Every improved delivery route made restocking more efficient. Every additional retail relationship expanded the company's reach. None of these decisions generated headlines on their own. Together, they created momentum. And momentum is one of the most powerful forces in business. Yet Coca-Cola's success wasn't built on logistics alone. Another factor quietly strengthened its position across many African markets. Instead of treating Africa as a single destination, the company learned to adapt to local conditions, local businesses, and local consumers. That approach would prove just as important as trucks, warehouses, or advertising. Because sometimes, the companies that win aren't the ones that speak the loudest. They're the ones that listen the best. One of the biggest mistakes global companies can make is assuming every market behaves the same way. What works in New York won't necessarily work in Nairobi. What succeeds in London may fail in Lagos. Africa's diversity means consumer habits, purchasing power, shopping patterns, and distribution challenges vary widely from one country to another. The companies that thrive are usually the ones that adapt instead of assuming one strategy fits every market. Coca-Cola embraced this reality by working closely with local bottling partners and distributors who understood the communities they served. Rather than trying to manage every detail from headquarters, the company relied on local expertise to help make decisions that fit each market. That flexibility allowed the business to respond more effectively to changing conditions and local demand. Instead of asking communities to adapt to Coca-Cola often adapted to the communities. Think about the last time you bought a cold drink. Chances are, you didn't spend several minutes comparing every available brand. You probably bought the one that was easy to find. This is something economists sometimes describe as the advantage of availability. The easier a product is to access, the more likely people are to choose it, especially when the alternatives require extra effort to find. Across many African markets, Coca-Cola focused on making its products consistently available in places people visited every day. The result wasn't just higher sales. It created familiarity. And familiarity builds trust. Over years and even decades, that trust became one of Coca-Cola's strongest competitive advantages. Not because customers were forced to choose Coca-Cola, but because it was often the brand they knew they could count on finding. Not at all. Pepsi continues to operate across numerous African countries, investing in partnerships, expanding product lines, and competing in different beverage categories. In some markets, it has achieved meaningful success and continues to challenge Coca-Cola. Competition between the two companies is far from over. Consumer preferences change. New technologies reshape distribution. Local beverage brands are also becoming stronger, giving customers more choices than ever before. The African beverage market continues to evolve. But changing decades of customer habits and distribution networks is never easy. The longer a company maintains an advantage, the harder it usually becomes for competitors to close the gap. That's why this rivalry remains one of the most fascinating case studies in modern business. It's tempting to believe that the company with the biggest advertising budget always wins. This story suggests something different. Brand recognition matters. Marketing matters. Product quality matters. But none of those advantages mean much if customers can't easily buy what you're selling. Coca-Cola's success across much of Africa wasn't built on a single brilliant campaign. It was built through thousands of small decisions repeated consistently over many years. Investing in infrastructure, strengthening partnerships, improving distribution, building trust, supporting retailers, thinking long-term. None of these decisions looked dramatic on their own. Together, they created an advantage that became incredibly difficult to replicate. That's a lesson that applies far beyond soft drinks. The rivalry between Coca-Cola and Pepsi is often remembered as a battle of commercials, celebrities, and catchy slogans. But across much of Africa, the real contest was decided somewhere else. It was decided on delivery routes, inside bottling plants, in neighborhood shops, through long-term relationships, and through a commitment to showing up, day after day, year after year. In the end, Coca-Cola didn't simply sell more drinks. It built a system that made choosing Coca-Cola the easiest option for millions of consumers. And that's an important reminder for every business. Sometimes, the company that wins isn't the one with the loudest marketing. It's the one that quietly solves the biggest problem before anyone else does. If you enjoyed this documentary and want more stories about the strategies that built the world's biggest companies, subscribe to Capital Theory. Because behind every successful business, there's a strategy most people never see. And we'll uncover it, one story at a time.